Well, amidst the volatility of Trump tariffs and geopolitical uncertainties, are investors missing out on great opportunities because they're too worried about sustainability of growth rates? Roger Montgomery from Montgomery Investment Management joins me now. Great to see you as always, Roger. Do you think, though, that
Thanks for having me on.
Can be some value here in record high share prices? We were just talking about CBA there.
Yeah, well, it's interesting, isn't it? If you'd said to me last year, Roger, there's going to be a mercurial US president. He's going to spark a trade war. He's going to get involved in the Middle East and drop bombs. Israel's going to expand its war with Palestine to Iran. If you'd said any of those things, and bond rates are going to remain high. If you'd said any of those things to me a year ago, I would have said, oh, look, surely the stock market's going to come down. And yet here we are, at all-time highs almost. And remember, the Fed has aggressively raised interest rates back in 2022. That should have crushed valuations as well, and it hasn't. The stocks are still hitting record highs, particularly a group of stocks. We've sort of moved on from FANG to a group of stocks that are now being referred to as mango stocks, believe it or not. And that's Meta, Apple, Nvidia, Google, and an unlisted company, which is OpenAI, that owns ChatGPT. So we've got the S&P 500 hitting all-time highs, and the Australian market, is very close to it as well.
Yeah.
PEs are at highs, and so investors understandably are a bit nervous about whether they should be buying. But I think those headlines are frightening investors when really they should be focusing on these businesses that are transforming the way that we work, that are transforming the way that we create, and they're growing at huge. I mean, we're talking explosive growth here. Those mango stocks that I mentioned, their forward free cash flow is growing at 24% compounded a year, and that is even after you take out their R&D spending. And their R&D spending is about 22% of sales, which is something like triple the average for the S&P 500.
Yeah, interesting. I haven't heard of mango. I've heard of Batman, but not mango. All right. Well, when you're talking there about the PE ratio, when was the last time that we saw the S&P 500's ratio where it is now?
Well, it was a ways back. I mean, we're at the highest levels now in about 45 years. The last time it was close to this level was in that 45-year window, was actually just around COVID. And so, we're looking at rates that normally people are frightened to invest at. And it's probably important to remember this. If you look at, if you're investing at all-time highs, I think this is a really clarifying statement. If you're investing at all-time highs, you're paying a price no one has ever paid before. Right? It's an all-time high. So that frightens a lot of people. But what you need to understand is when we look historically at the data, what we find is that corrections of more than 10% have only occurred in 9% of the 1,500 times over the last 40 years or so. Actually, since 1950, there's been 1,500 instances of new all-time highs, and only 9% of those, I guess, were followed by a correction of more than 10%. And so, really, investing at all-time highs, while it seems frightening, is not necessarily that scary on a historical basis, particularly if investing in those companies that are growing at a great rate of knots. And I think a lot of what's going on geopolitically, as you mentioned, and we talked about earlier, a lot of that is just unfortunately scaring people from buying these businesses that are going to be many, many times bigger in the future. If you don't mind me saying, if we've got the time, Nvidia, back in August 23, Nvidia was on a PE of 245 times its historical earnings. The market was trading at 24 times. So there was a stock that was trading 10 times higher than the average price to earnings ratio of the S&P 500. So you couldn't describe it as a value stock, But over the next 2 years, up until now, it's rallied more than 200%. And I think that's because, and by the way, the S&P's gone up as well, but it's only gone up 32%. And the reason for that is that profits have soared. Back in 23, NVIDIA's net income for the previous 12 months was $10 billion. And a year later, it was $53 billion. And in the most recent quarter, it was $76 billion. So if you can find those businesses, and by the way, it's easier to say than do, but if you can find those businesses that are going to grow their earnings, then it really doesn't matter what Trump does. It doesn't matter what Netanyahu does. None of those things are really going to count.
So does that then, to that point, Roger, we should be less focused on the ins and outs of what President Trump is doing, where bond yields are going, and look more at this momentum we're seeing, which is particularly, as you've been talking about, AI, that's going to leave us all in the dust if we don't sort of play catch up now?
Yeah, I think so. I think it's a little bit of arithmetic's kind of helpful here. So if you buy and sell a stock on the same PE ratio, then your IRR, or your internal rate of return. So let's say you bought something today on a PE of 25, and if you sell it in 5 years' time on a PE of 25, then your return is going to equal the earnings per share growth rate of that company. So then that compels you to find businesses like the one we've just described, NVIDIA, that are growing their earnings at a very fast rate. Because even if the PE doesn't change, you're going to get the earnings per share growth rate as your return. And even if the PE does fall, let's say, and so now NVIDIA's PE was 245 2 years ago, it's now 50 times. And that PE's come down, but you've still made a lot of money. So even if the PE falls, even if investors aren't as optimistic or they aren't as enthusiastic about a company and the PE drops, well, as long as the earnings growth rate is fast enough, you're still going to do well over a 3, 4, 5 year window. And so there's a couple of things you want to do. You want to find businesses that are growing very quickly, and you want to ideally buy them, for as long as they're continuing to grow their earnings at a very high rate, and you'll do okay. In fact, you'll do much better than okay.